Okay, so have you ever been there? You know, you're in a meeting, maybe pitching something brilliant, or just trying to figure out your next career step. And boom, this phrase pops up. Technical economic analysis.
Hmm.
Maybe it's something you kind of glossed over in college or never really encountered. Only now, suddenly, it feels like the most critical skill. Like, does this idea actually have legs, financially speaking?
Yep.
Or maybe you're dreaming of starting your own thing, right? An entrepreneur, you've got the vision, but then reality hits. How do you actually estimate the costs? What's the potential return?
Right. The practical side.
Exactly. It's that moment you realize, okay, the tech is cool, the idea is great, but the money side, non-negotiable. And you get that little pang, wishing you'd maybe focus a bit less on, I don't know, kinetics and more on this
Oh,
stuff.
absolutely. Those scenarios. Incredibly common. Happens all the time. And look, technical economic analysis, it's not just some abstract academic thing. It's really fundamental. It underpins huge decisions everywhere.
Yeah.
Seriously, from like super advanced engineering projects
Mhm.
down to setting up a local coffee shop. It's the backbone for making smart investment choices.
Hmm.
So today, that's what we're doing, a deep dive.
Yeah.
Our mission, really, is to give you a clear, kind of intuitive handle on it.
Mm.
Practical, too. We want to cut through the jargon, show you how the pieces fit, whether you need the basics or something more advanced.
Okay, perfect. So let's get right into that, the why and the what of it all. At its core, it's about making informed decisions on where to put money, right? Investment decisions.
Exactly.
It means systematically figuring out costs, understanding how cash flows in and out over time,
That cash flow piece is key.
and then ultimately deciding, is this actually worth it? But here's the tricky part, and maybe where the anxiety comes in. You're often dealing with data that's, well, not perfect. There's a lot of uncertainty.
Significant uncertainty, yeah.
And yet, you have to make calls involving potentially millions, or like you said, even billions of dollars or pounds or whatever local currency.
That's the high-stakes reality. It's
Yeah.
real money. Could be investors' cash, could be your life savings if it's your own venture.
Right. So the pressure's on, the margin for error feels tiny.
It really does. And our sources actually break this down quite nicely. They talk about a basic package and an advanced package.
Okay.
So the basic package, that's your foundation. It's about nailing those crucial estimates, initial investment, ongoing operational costs, and then doing a thorough cash flow analysis based on that.
Right.
This groundwork lets you calculate key economic performance indicators. Now, for folks familiar with finance terms, we're talking things like AR,
Rate of return.
exactly, internal rate of return, and VPL.
Net present value. Okay, I've heard those.
Right. Now, for anyone less familiar, just briefly, PIR, the internal rate of return. Think of it like the project's effective interest rate. It tells you the return you're generating internally from the investment over its whole life.
Okay. So higher is generally better.
Generally, yes. If it's higher than your cost of borrowing money or your minimum target, that's a good sign. Then there's VPL, net present value. This one's really important because it tackles the time value of money.
The idea that a dollar today is worth more than a dollar tomorrow.
Precisely. VPL takes all your future expected cash flows, positive and negative, and discounts them back to what they're worth right now.
I see.
If the VPL is positive, the project is expected, over its life, to generate more value than it costs, considering that time value. It's literally adding wealth.
Okay, that makes sense. So these aren't just random acronyms. They give you a much deeper financial insight.
They absolutely do, much richer than just simple payback, which we'll get to.
Right. And then you mentioned the advanced package.
Yes, so the advanced package is where you really start wrestling with that uncertainty we talked about.
Well, what ifs?
Exactly. You move beyond just single best guesses and start asking, okay, but what if our yield isn't as high as we hope?
Or what if the price of our main raw material suddenly spikes?
Precisely those kinds of critical questions. That's where you bring in sensitivity analysis, investment risk analysis. It's about understanding the potential downsides, where the vulnerabilities are, and maybe how to build in some buffers.
Okay, this is making sense. Maybe we can make it even more concrete. An example.
Perfect idea.
Yeah.
Intuition first always helps.
So let's imagine you're thinking about opening a restaurant. Classic small business dream, right?
Relatable.
You've done some homework, cost estimates, market research, and you've got 3 options on the table. Let's pull the numbers from table 1 in our sources. Option 1, a Japanese place, needs a cool million Brazilian reais to start. That's 1,000 KR in the source notation.
Okay, 1 million R. Got it.
Projected annual revenue is 400 KR. Annual expenses maybe 300 KR.
Okay.
Option 2, Italian, Bit cheaper to start, 800 KRR dollars. Annual revenue projected at 300 KRR, expenses at 220 KRs.
Right.
And option 3, a Brazilian restaurant. Investment is 900K, so kind of in the middle, but revenues look higher, 500K a year, and expenses at 250K.
Okay, 3 distinct options. So if you're just looking at this intuitively, financially, what jumps out?
Well, first, just the sheer investment, right? Can I afford that million for the Japanese place?
Good point. Initial barrier. What else?
Then just the basic profit each year, revenues minus expenses.
Yeah, the annual bottom line.
And third, probably how long it takes to get my initial money back. The payback time.
Exactly. That's often a huge factor.
Yeah.
Payback time, how quickly do you recoup that initial investment? So let's crunch those numbers quickly. Japanese, 400K revenue minus 300K expenses is 100K profit per year.
Okay.
Investment was 1 million. So
Yeah.
1 million divided by 100K.
10 years.
10 years payback. Okay, Italian. 300K revenue minus 220K expenses is 80K profit. Investment was 800K. So 800K divided by 80K.
Also 10 years.
Also 10 years. Okay, interesting. Long wait for both.
Yeah.
Now, the Brazilian one, 500K revenue minus 250K expenses gives you 250K profit per year.
Wow, much bigger profit.
Right, and the investment was 900K. So 900K divided by 250K.
Let's see, 900 over 250. It's less than 4.
Yeah.
About 3.6 years.
Exactly. Roughly 3.6 years.
So just looking at payback time,
The Brazilian option looks way better. You get your money back much, much faster.
significantly faster. Your capital isn't tied up for as long. So based purely on that simple payback metric, the Brazilian restaurant seems the most financially attractive.
That definitely seems logical. Faster payback feels safer, maybe. But you hinted earlier that payback time isn't the whole story.
That's a really sharp point. It brings up a critical question. What are the limits of just using payback? Could it mislead you sometimes?
Yeah, like, is it ever not the best measure?
Absolutely. And this is precisely why we need those other tools like VPL and TIR. Simple payback is great for a quick gut check, really useful, but it has 2 big flaws. First, as we touched on, it totally ignores the time value of money.
Right. A profit in year 1 isn't the same as the same profit 10 years later.
Exactly. Inflation erodes value, plus you could have invested that money elsewhere. Payback doesn't care when the money comes back, just that it does. Okay, flaw number 1, what's the second?
It completely ignores any cash flows after the payback period is over.
So a project could pay back quickly, but then maybe profits dry up.
Precisely. Or, conversely, another project might have a slightly longer payback, say 5 years instead of 3, but then it generates massive stable profits for the next 20 years after that. Payback analysis wouldn't show you that long-term benefit.
I see. So it's kind of short-sighted on its own?
It can be, yeah. That's why VPL, net present value, is often considered superior. It looks at all the cash flows over the entire project life and discounts them properly. Gives you that single number. Is this project creating wealth, yes or no?
And TIR, the internal rate of return, gives you that percentage return to compare against other things.
Exactly. It helps you gauge the efficiency of your investment over time. So maybe a project with a slightly longer payback has a much higher TIR, meaning it's ultimately a more profitable use of capital in the long run.
Okay, that clarifies why you need more than just the simple payback. It's about getting the full, accurate financial picture. Now, I can almost hear some listeners thinking, okay, restaurants are nice, but I didn't study, say, chemical engineering to open one.
Uh-huh. Fair enough. And I totally get that.
But here's the connection, right? The
Yeah.
fundamental thinking, the principles we just used.
They are exactly the same.
Whether it's a restaurant or a massive complex chemical plant or a new software venture or an energy project.
Precisely. The scale changes, the technical details change dramatically, obviously.
Yeah.
But the core economic questions, they remain the same.
Yeah.
You still need an initial investment for reactors, software development, drilling rigs, whatever.
Equipment installation.
Raw materials, operating costs, salaries, energy.
And you're still aiming to generate revenue, make a profit, and get a good return on that initial investment.
Exactly. And if we link this back to engineering specifically, like in chemical engineering, the engineer's role is absolutely crucial here. As our sources highlight, the engineer isn't just finding a technical solution in isolation.
Right.
Their job is to find a technical design, a process that also makes the whole thing economically viable, attractive to investors.
So they're trying to design it to minimize payback, maximize VPL, hit that target TIR.
That's the heart of it. They need to optimize the process technically in a way that achieves the desired economic outcomes.
Yeah.
It shows perfectly how technical decisions and economic constraints are totally intertwined. You can't separate them.
Yeah, an amazing technical process that costs way too much is, well, just an amazing technical process on paper.
Exactly. It won't get built.
Yeah.
I remember seeing this brilliant pilot project once, a totally new way to make a certain material. Science was sound.
Uh-huh.
But when they did the full economic analysis, the energy consumption was just too high. Killed the VPL project, shelved.
Wow. Harsh reality.
Real-world technical economic analysis in action.
Okay, so that really bridges the gap. So let's talk about the actual doing of it. What are the steps involved in a full analysis? Let's map it out, maybe following that figure 2 from the sources.
Great idea. Let's walk through the roadmap.
Step 1, process definition. Makes sense. You need to know exactly what process you're analyzing first.
Right. What are we building or implementing? This starts with diagrams.
Block diagrams first, maybe, for the big picture.
Yep. High-level overview.
Yeah.
Then you drill down into detailed process flow diagrams, or PFDs, showing every pump, every reactor, every stream.
So you define the technical scope very clearly.
Crucial first step. Then step 2, mass and energy balances.
Ah, the core engineering calculations.
Absolutely. This is where the technical data really gets generated.
Yeah.
You use tools could be Excel for simpler things, or powerful process simulators like Aspen Plus, HYSYS for complex chemical processes.
And what are you calculating here?
Everything flowing in and out, how much raw material goes in, how much steam, water, electricity is consumed. That's your input side, driving costs. And on the output side, crucially, how much product are you making? The mass flow rate of your saleable product, that drives your revenue estimates.
Got it. So accuracy here is paramount. Garbage in, garbage out for the economics later.
Precisely. Errors here ripple through everything.
Okay, step 2, done. What's
Yeah.
next? Step 3, cost estimation.
Right. Now you start putting dollar figures, or whatever currency, on things. Primarily, the initial capital estimate. Estimating the cost to purchase all that equipment shown on your PFDs, plus the cost to actually install it all.
That sounds difficult, especially for new technology.
It is challenging.
Right.
And there are different levels of accuracy. Early on, you might do an order of magnitude estimate, maybe plus minus 30, 50% accuracy.
Okay.
Later, as the design gets detailed, you aim for a definitive estimate, maybe plus minus 5, 10%.
Yeah.
It requires more data, more effort, sometimes vendor quotes.
Needs real expertise and good data sources.
Definitely. Historical data, vendor contacts, specialized databases.
Right? Step 3, capital cost estimation. Then step 4, comprehensive calculations. Sounds like bringing it all together.
Exactly. You now combine your estimated investment costs, step 3, with your ongoing operational costs. Those operational costs come largely from your mass and energy balances, step 2, costs of raw materials, utilities, but also things like labor, maintenance, insurance, taxes.
Okay.
And you also factor in your projected revenues based on your product output, step 2, and estimated selling prices.
So you're building a full financial model year by year, maybe?
Typically, yes. You model all the money flowing in and out over the expected life of the project.
Which leads perfectly into step 5, cash flow analysis.
Bingo!
Wow.
You take all those costs and revenues from step 4 and map them out over time, usually in a table, often visualized in a cash flow diagram.
Showing the net cash position each year.
Exactly. When are the big outflows, like the initial investment?
Yeah.
When do the positive cash flows from sales start coming in? This detailed, time-based picture is absolutely critical.
Because that's the raw data for the fancy metrics, right?
Precisely. The cash flow analysis is the direct input for calculating things like VPL and TIR.
Okay. And that brings us to the grand finale. Step 6, economic performance indicators.
This is it. Decision time. You take that cash flow data from step 5 and calculate your key metrics, your TIR, your VPL, your simple payback time. Maybe others too, depending on the industry.
And these numbers are what go to management.
Yep. These indicators tell the story. They allow decision makers to judge the project's financial merit. Is it good enough? Is it better than other options? Do we proceed? Do we tweak the design and reevaluate? Or do we, shelve it?
The moment of truth, as you said.
It really is.
And just looping back quickly to the advanced package, that stuff fits in here too, right?
Yeah.
Sensitivity and risk analysis.
Excellent point, yes. A really thorough analysis doesn't stop at just calculating single-point VPL or TIR values based on your best guess estimates.
Because those best guesses might be wrong.
They often are. So sensitivity analysis is key. You systematically change your key assumptions one by one.
Like what happens to VPL if the raw material price is 10% higher or 10% lower?
Exactly. Or if the selling price changes, or the plant uptime, or the initial investment cost. You see how sensitive your project's profitability is to each major variable, often shown visually in a tornado chart.
Right. Showing which factors have the biggest impact, good or bad, helps you focus.
Precisely. Tells you where your biggest risks lie.
And then there's the even more advanced investment risk analysis.
Right. That takes it a step further. Instead of changing just one variable at a time, you look at uncertainty in multiple variables simultaneously. You might assign probability distributions to things like selling price or operating costs, saying it's most likely to be X, but it could range from Y to Z.
Okay. How do you handle that complexity?
Often using techniques like Monte Carlo simulation.
Hmm.
Software runs thousands, even millions of possible scenarios based on those probability distributions.
Wow.
And instead of getting one VPL number, you get a distribution of possible VPLs. It might tell you there's an 80% chance the VPL will be positive, or there's a 15% chance we could actually lose money.
That sounds incredibly powerful for understanding the real risk profile.
It is. It gives decision makers a much richer understanding of the potential range of outcomes, not just a single, possibly misleading number.
Okay. Wow. So as we kind of wrap this up, we've really gone on a journey here. From that initial, maybe slightly anxious feeling about technical economic analysis to understanding its core job, making smart investment calls. We saw the intuition with the simple restaurant example.
Yeah, the payback idea.
Then bridged that to complex engineering, realizing the principles are the same. And finally, we've mapped out the systematic steps from process definition right through to those advanced risk tools.
Yeah, a solid framework.
So hopefully listeners now feel they have a much better handle on how to approach these crucial analyses.
I hope so too. And maybe connecting it back to that bigger picture. Remember, we focused a lot on the how-to, the steps. But the real strategic power, especially in complex projects, often comes from asking those what-if questions.
The sensitivity and risk analysis part?
Exactly. The ability to not just calculate a number, but to quantify the uncertainty around it, assess its impact. That's what makes an analysis truly robust, truly insightful. It's what helps you build resilience, anticipate problems, and make genuinely informed decisions under pressure.
That's a great final thought. It's not just about the numbers, but understanding the confidence in those numbers.
Couldn't have said it better. So maybe a provocative thought to leave folks with.
Go for it.
The next time you read about a big company investing billions, or even when you're making a personal financial decision, buying a car, choosing a degree, ask yourself, what are the underlying technical economic factors here? What kind of payback are they implicitly looking for? What's the likely VPL? And crucially, how much uncertainty have they really thought about and planned for? Because this way of thinking, this lens, it isn't just for engineers or CEOs. It's a really powerful way to understand the world of business, innovation, and even just make smarter choices in your own life.